Welcome to Multifamily Roadmaps Lunch and Learn on how to become the go-to real estate agent or realtor for multifamily investing in your area. My name is John Castle. Let's get this thing started. All righty. Like I said, we're going to cover on how to become the go-to realtor or agent in your area for multifamily investing. Show you kind of how to do that, and what sort of benefits that you'll get from doing that. So let's dive right in. So what is considered multifamily? Most of you may know, but basically multifamily is rental real estate, but with multiple units. So this could be an apartment building or even a large house that was divided into apartments. In general, anything 2 to 4 units will be considered smaller multifamily, and anything that's 5 units and up will be considered larger multifamily. The 2 to 4 units will qualify for the same residential loan that you could get for just a single family home. So you could get a 30-year fixed residential loan for that. And anything 5 units and up will generally need a commercial loan, and won't qualify for the 30-year fixed. So you'll be looking at something like a 5-year fixed rate, 20-year loan term, and usually at that end of 5 years, you'd either refinance into a new loan, or it would go for another 5 years but turn into adjustable rate. So that could be dangerous if mortgage interest rates are looking to go up. Like that would have been dangerous if that happened recently for you, and then the Fed started raising rates to about 6% is where the rates are at the moment. So what are some of the benefits of multifamily investing versus just investing in a single family rental? Since you have multiple units, you have more protection from vacancy. In a single family, if your renter moves out, you're 100% vacant and have no income until that unit's filled. So with multifamily, you have other tenants still there. So if you have a 3 unit, you got one moves out, you still have 2 there that can bring you in some income and at least cover the expenses, and maybe cover most of the mortgage for the time being. So instead of just you're left holding a full mortgage, you got most of the expenses and mortgage paid for that month until you can fill that unit and start making money again. There's also economies of scale for maintenance and bigger ticket items, like an HVAC or a roof. Typically, you'd have more apartments under one roof, so you have one HVAC system to fix, one roof for 3 to 4 units, instead of having to fix 4 roofs over 4 different single family homes spread out through different areas. So you get the economies of scale there with multifamily. You can generally get more rent for the price you pay due to having multiple rental streams in the multifamily. So think of like a single family, maybe it rents for $1,400 a month for the typical single family in your area. Let's say it's $150,000. If you get like a 3 unit for that same $150,000, the units definitely be smaller. But let's say all 3 of them rent out for $700 a month. So you're totaling $2,100 a month versus the $1,400 that you would have in the single family for the same purchase price. This makes it easier for the property to produce cash flow each month as well, just with the higher rent to price ratio that you're paying. Portion of the value for multifamily families is tied to the income they produce. So it has a higher upside than just the single families that use a comparable method, that maybe it can only go up to 170 because of the neighboring properties top out at about that. But if you get the more units that you get, the more valuation takes into account for what the property is worth. So income that you can produce in that property can always go up if you make improvements, add units, et cetera, et cetera. So you have a higher upside potential for the price of the property by just increasing the income and bottom line. So it has a better valuation method than single family houses. And then multifamilies also have less competition. So if you're investing in single family properties, you'll be competing with flippers, first time home buyers, a couple that's looking to buy their first home, or other investors that are just looking to buy single family rentals. In the multifamily space, you're just basically dealing with just other investors and a lot of investors don't even touch multifamily and stay in the single family range. So, the people that you're competing with for a price on that property, or just purchasing that, bidding on that property, is going to be a lot less in the multifamily versus the single family. So how do you, as an agent, you're selling the properties, how do you stand out to investors and become that kind of go-to in your area for investors to buy properties from? So step one, you need to know the different investing strategies. There's a cash flow play, so that's just buying a rental property, not really fixing it up, and then just having the rent produce income each month in the form of cash flow. So cash flow is basically just income minus expenses minus the mortgage, and then if there's money left over, that's the cash flow per month. So some people just buy rental properties, just hold them, just let it cash flow a little bit each month, and take that to the bank. Another one is a long-term payoff strategy. So it's just someone buying a rental property that wants to just hold it forever, let the tenants basically pay off the mortgage, and then in 20, 30 years, they own that home free and clear, no mortgage on it, and just kind of like almost like a retirement plan instead of investing it in the stock market or something like that. They're not looking to cash flow a whole bunch. They just want to make the mortgage and just hold it, let it appreciate, let the tenants pay off the mortgage, and then have a free and clear property down the road. Fix and flip is another strategy that's obviously, popular. You see that on TV. You already know about that. That's basically you just buy a rough property, fix it, and then flip it for a profit. So you're not holding on to the property. You're just short term trying to get it done, renovate it, and get out of there. And the last one that's most common in multifamily, and probably the best strategy, the one that I use, is the BRRRR value add strategy. So BRRRR stands for buy, renovate, rent, refinance, and then repeat. So it's a value add strategy. You kind of do the same thing as a flipper. You get a property that either has low rents or needs some work. You renovate it, get it producing more income by getting it up to market rents. Then you refinance it, and at refinance, since it's worth significantly more value, you pull a bunch of the cash that you put into the property back out, and then you just hold it long term for cash flow after you pull your investment back out, and then you just repeat that strategy. So let's just say you pulled $70,000 that you put into property back out, you just put that into another property, and keep that kind of snowball going. Another thing that you're going to need to know is the important terms. So you can speak the investor's language. Stuff like cash flow, I already touched on that one. So that's income minus all the expenses minus the mortgage, and then the cash flow would be anything you have left over after that. The net operating income is just the income, gross income minus any expenses, and that's basically how the property is valued for the area on the NOI that it produces. So that's before the mortgage payment. Expense ratio is basically just the percentage of expenses versus the income that the property is producing. So traditionally, that'll be in the 45 to 55% range. So that include vacancy and include all the other expenses that you would take into account. And so you can kind of know where that property is. If it's only producing at 40%, it's run really well, or if the expense ratio is in the 55, 60, 65% range. There's probably some opportunity there because it's not either not being run well or the expenses are just too high. So ROI, or cash on cash return, they're kind of interchangeable. ROI is obviously return on investment, but that's basically, you would just basically take the cash flow that you get per month, per year, I should say, and then divide that by the amount that you invested in the property to take it down. So you divide it by any down payment that you needed, closing costs, and then any other money that you put in, maybe renovations. And then you divide the cash flow by that total money invested to give you a return investment on your money, or cash on cash return. Another main one, which is basically more for the BRRRR method, internal rate of return. It's basically for simplest terms, it's taking into multiple years of the property's returns, discounting each year in the future a little bit, and then giving you a total return for the property. You don't need to know any sort of formula for that. You can just use Excel, but just know what that term is. And that's generally the best way to analyze an investment property over multiple years. to get a good kind of single return number by taking into multiple years of cash flows and exit price and what you put into the property all into one. So, and the last main step is having a grasp of analyzing a multifamily deal. So we can run through this quick. This is an example. It's a 4-unit property. So you get two bedrooms, 2 1-bedrooms. Here's your rents: 850 for the 2 bedrooms, 700 a piece for the 1 bedrooms. So this is all kind of the general stuff that you should know off the top of your head. So you get the monthly income, and then you just times it by 12 to get the yearly. But a key factor here is the vacancy. A lot of agents will either just disregard vacancy together or budget it really low, like 3% or 2%. You want to definitely keep that, especially in the smaller multifamilies, higher, 8 to 10%, just to be safe. So you're giving your investor client good numbers, and you're not getting them into a property where they're, budgeting 2% for vacancy and then having 10% and just kind of being underwater on the property. So you would take any additional income after you take off the vacancy, get you a gross income. So that's stage 1 is finding the income. And then step 2 is breaking down the expenses. So we have the gross income, we calculated up here, and then we're going to break down all the normal expenses. So taxes, that's obvious. Taxes, insurance are obviously, self-explanatory, they're included. And then you would include any sort of utilities that the landlord would be paying. So right here, I have electric included. Usually that's covered by the tenants in almost all areas, but that's why I have common area here. This is just like a common area, like a outside of the building, or just like an inside that the landlord would cover. And then gas, water, sewer, trash, just estimated those for this example here, saying that that's what the landlord's covering for this 4-unit. Property management, maintenance, and capital expenditures are the big 3 that agents often leave out, or just novice investors leave out, that you'll want to include. Property management is usually 8 to 10% for smaller to mid-sized multifamilies. For all areas, it's 10% of the income. So that's where you get 34, 8, 7. And then maintenance and capital expenditures, usually these will be left off when information is provided to an investor, but you'll definitely want to include these and budget these out. So maintenance, usually depending on how nice or rough the unit is, I usually like to budget anywhere from 400 to 800 per unit. 800 obviously on the rougher side. And then for capital expenditures, this is so you can basically build up a reserve. So when the roof goes out or the HVAC goes out, you had already put a certain amount away each month for that. So when that comes due, you say you need $10,000 roof, you had already saved the $10,000 over, 5 years or whatever it is, for that roof. So usually anywhere from, 200 to 400 is a good measure for capital expenditures. And then just some other expenses like contract expenses is often one that's left off. So that could be lawn, snow care. It's usually not a huge number, but leaving it off skews your numbers and can kind of make a good deal or a great deal not look as good. And then just any other miscellaneous expenses. So here you calculate the expense ratio down here. That's basically taking all these expenses and adding back in that vacancy and then dividing it by the rental income up here, to give you a 53% expense ratio. So that's about on par for a 4-unit, kind of older 4-unit property. So there's nothing really out of whack here. And then just to run down to know how to calculate cash flow, because investor cash flow will be one of the main things the investor will be looking for. You're looking at price at $200,000, so you're getting a loan for $75,000 or a 75% loan to value. I apologize. So $150,000 loan. Usually for investment properties, 75% is the highest you can get. Sometimes you can get 80% loan to value, but generally 75 is the limit. So you get 75% loan to value mortgage of $150,000. I estimate it at 6%, and you're getting a 30-year fixed mortgage. That gives you a monthly payment of $899. And yearly mortgage comes out to $10,788. So you take the income, the $34,000 that you calculated first, take the total expenses that you calculated second, And that gives you the net operating income of $19,000. You take off the $10,000 yearly mortgage and project this property cash flow $8,300 a year. So this is just kind of a simple analysis, but these are the ones. You should be able to do this if you want to get good numbers to investor. Basically look like you know what you're doing. If you want to obviously dig deeper on this, you'd want to dig into some of these numbers more, project out a couple years. I actually have a course on that on the website if you're interested, multifamilyroadmap.com, course analysis. So you can do that and get a little deeper, but this is what you need to know to basically sell yourself as an agent to an investor, numbers wise, and what to provide them so they can do a proper analysis. If you don't do this yourself, basically, you're going to be sending them a deal that you're going to be like, oh, this looks like a great deal on paper, but you left out 3 or 4 different types of expenses. Maybe you left out maintenance, capital expenditures, and property management. So you're selling them, this is a great deal. And if it's a rookie investor, they'll basically take your word for it, end up getting a bad deal, souring on investing, won't be coming back to you, gonna give you bad reviews. But if you give all this information to a good investor, they'll be like, oh yeah, he knows exactly what he's doing. This is, save me time from gathering this information. And then at his local meetups and all the other investor friends he knows, the groups that he's in, he'll share your information, because a lot of investors are looking for good agents that even understand kind of the basics of investing, especially in multifamily. So you don't need to know a whole bunch to stand out on the analysis portion. But if you do know that, you can really become the go-to guy. So how does this impact your business? So how do you become the go-to investor? And then what does that do to benefit you? So by knowing the basics of investing, you will stand out among a sea of agents who know, like I said, little to nothing about investment properties. So it'll be easy to stand out. But by providing that great service to one investor, you'll benefit from tons of free word of mouth advertising as you share your info with other investors, as they share your info with other investors, I should say, and just kind of get you free word of mouth. You got people just messaging you, emailing you out of the blue. Hey, can you be the agent for me as well? I'm looking for properties. I'm looking for this, that, whatever. And a big thing with that is investors usually buy multiple deals a year, unlike most single family clients who might only buy, let's say, once every 5 to 7 years when they're just looking for a new home. So you're always in the single family space, you're always churning new clients because you sell them a house, they live in that with their family for 7 years, then it's time to move again. Maybe they forgot you, maybe you're not, they moved to a different state or whatever. If you can get just a handful of good investors that look to you for deals, they will be buying multiple deals from you. You won't have to keep churning new people. And it'll allow you to kind of focus more on the seller side of things, because you're not looking as much for clients. You're just looking for properties that the seller wants to sell. So multifamily properties that the seller wants to get rid of, and you can just sell those to your investor clients, and kind of narrows down your focus of marketing. You're only marketing 4 deals for sale. And you should already be pretty good at marketing, because that's what you should do, be finding clients anyway. So all you have to do is really expand your base to include multifamily properties and the properties that you're looking to find sellers on. So on the personal side, you'll get to see some of the best deals, because you'll be marketing to multifamily sellers that are looking to get out. So the best deals will come across your desk first. So you could actually keep them for yourself, as long as you understand, go through a little process of understanding how to properly analyze deals, and just building your knowledge base. You'll be able to actually acquire some of the best deals yourself. And then the ones that are just pretty good properties, or pretty good deals, but like maybe areas that you don't want, or it's just bad timing, you can then sell those to the investor clients you have. So you basically get a win-win there. You get the best deals for yourself, can get some of the other good deals that you don't need off to someone else. And then that allows you to build a side income So when maybe like there's lulls in the year where you don't sell a lot of properties, you have a couple rental properties that produce a couple $100 a month for you. You don't have to stress about selling. Oh, I need to sell a property this month, or I have no income. You have a stable side income that works every month of the year. There's no sort of seasonality to it. And you can also use that to either build a side income to make that your main thing, if you don't want to be an agent anymore, or you could just use it as kind of more of a retirement plan. Buy a couple multifamily properties, let them throw off some income for you, and then over time, that's how you retire. You don't need a big 401k because you own 3 or 4 multifamily properties that now they're paid off, they produce income, and you can just kind of sit pretty there. So, like I said, make it a win-win for you. Keep the best deals for yourself, and build your personal wealth. Pass along all those other good deals in order to grow your main agent business. So that's kind of how you become the go-to agent, and what sort of benefits multifamily investing can have on your career, your business side, and your personal side. So that's kind of it for the Lunch and Learn. If there's any questions, I'm here. Let me know if there's any questions. No one? All righty. Well, if there's no questions, that'll be it. Thanks for joining me on the Lunch and Learn. Hope you have a great rest of your day.